Welcome, and thank you all for standing by. I would like to remind parties all lines have been placed on a listen-only mode until the question-and-answer portion of today's conference. At that time, you may press star 1 on your touch-tone phone to ask a question. Today's call is being recorded. If you have any objections, you may disconnect. I'd now like to turn conference over to Linda Abrazizi. Thank you. You may begin.
Thank you, and good afternoon for those of you joining from the East Coast, and good morning for those of you joining on the West Coast. Thank you for joining for our Department of Commerce Trade Technologies webinar series on cargo insurance. And I'm pleased to note that we have almost 50 people registered for this webinar today. In this webinar, you will learn the basics of cargo insurance coverage and what it is prudent to be insured outside conditions. You will understand that risk should be calculated and not overlooked. And in this webinar, you will learn about how insurance conditions insurance conditions for types of trade payments, financing options, general liability, all risks, and Incoterm applications. A question and answer session will be presented after the main presentation. My name is Linda Abrazizi, and I'm a Senior International Trade Specialist for the Global Knowledge Center for the U.S. Commercial Service, Global Markets, Department of Commerce, and I will be today's moderator. This webinar is being brought to you by the U.S. and Foreign Commercial Service and Global Markets and Trade Technologies. And I'd like to welcome all the U.S. and Foreign Commercial Service clients, as well as other participants joining us all across the United States to learn about cargo insurance. In a moment, I'll turn this presentation over to Melissa McLamurray, who is our Client Support Representative for Trade Technologies. Also, our other speaker is Sherry Lane, who's the Director of Consulting and Insurance Services for Trade Technologies. These will be our main speakers for today's webinar. Now, all speakers will be available at the end of this presentation to answer your questions, and contact information will also be provided. Now, for those of you just joined, you can still log on to this webinar by entering the URL website and passcode per instructions that were sent to you by email. So we have a few housekeeping details to make sure everyone gets the most benefit from today's webinar. You will be able to hear this presentation via your telephone and view it simultaneously via your computer. If you are not hooked up through both, please take a moment to do this. And if you're experiencing any technical difficulties, please press star 0 anytime during this presentation. And during this webinar, we will be taking voice and written questions. So, to ask a voice question, please press star 1. To ask a written question, we invite you to type in your questions on your screen as they occur to you during this presentation. On the upper left-hand side of your computer, there's an icon with the letters Q and A, which stand obviously for question and answers, where you can click and type in your questions anytime during this presentation. We will compile these questions and present as many as time allows after the presentation. Type questions which are not answered during this webinar due to time constraints, we will get back to you via a personal email. And now with that, I'd like to introduce Melissa McLamurray, our Client Support Representative of Trade Technologies. Melissa, thank you very much for joining us.
Thank you, Linda. And good morning and good afternoon, everyone. So today I'm going to look at our agenda, and for our agenda today, we're going to start by identifying different types of cargo insurance risk, and we're going to touch on financing risk and Incoterm risk. Then Sherry's going to go into coverage shortfalls, and under that covered special insurance clauses as well as carrier liability. Then we're going to segue into a internal Q&A where we're offering situations and real-life solutions to those situations covering inadequate cargo insurance. And then hopefully by the end of today, the objective is to understand cargo insurance. And the ultimate objective is to understand who needs to purchase cargo insurance and why. So I'm going to turn this over to Sherry.
Yeah, thank you, Melissa. Good afternoon. Good morning, everyone. Financing risk is just one of the conditions that can open the door to unforeseen losses. By extending lengthy payments beyond transit times, or selling on open accounts and time payments, or even shipping the product prior to solidifying the financing, can all be risky and create risk conditions. The Incoterms is another area used that can, by definition, the Incoterms assign insurance risk to either the buyer or the seller. But this does not guarantee that the insurance will actually be secured against the cargo. Under the DAT and DAP and DDP, it is certainly in the shipper's best interest to be sure to obtain cargo insurance. The other terms, F and C terms, state, without the I in between, of course, state that the buyer is supposed to insure the goods. However, as a shipper, you still may need a contingency plan, and we'll go into that in more detail as we proceed. There are coverage shortfalls. This is a list of the summary of commonly overlooked conditions. We're going to review these in this presentation based on our real-life examples of losses that have been incurred by sellers and shippers. Whether it is the intent of the insurance, the warranties issued, the extended coverage through added clauses, or carrier liability, any of these situations can cause an unnecessary risk for losses that you should be aware of. Now back to Melissa.
Well, thanks, Sherry. And so now we're going to segue into our situation and solutions. And so we all have heard horror stories. And so today we're going to share some of the horror stories that you may have heard. Hopefully you've not experienced these, but not just what can we do after the fact, but what can we do prior to this? How can we prevent or protect ourselves when bad things happen? So our first situation of the day is intent of coverage. So we have a situation where an exporter is shipping, and you have a ship, as they're shipping from China to Long Beach, that the ship sinks en route. And the documents were issued by the forwarder, but due to the sinking, there's a total loss of the goods. So Sherry, how are we going to be able to recoup anything, or how could we have prevented, or covered ourselves more adequately?
Well, that's a good question, and one that's very commonly overlooked. Whenever you want insurance, you should always issue an intent of coverage, and by that I mean put in writing to your forwarders, or to your carrier, whoever is issuing the insurance certificate, that you have the intent to insure your shipment prior to actual shipment or loading on board the vessel. The reason for this is that some underwriters may exclude coverage since you did not state your intention, and the vessel sinks before the documents are issued, and there's no proof that you requested the insurance. It may negate your insurance altogether. So it's just a very good idea that when you want coverage that you explicitly explain to your forwarder or carrier provider that you want insurance, that you want all risk, or whatever it is that you're asking for in your particular case, and be very specific that you don't want carrier liability insurance, but you want full coverage, all risk insurance. And we'll go into the carrier liability here very shortly.
Thank you. So our next situation is dealing a little bit with an inland calamity. And so in our situation, we have a $500,000 container load of electronics, and they're seized en route to the buyer facilities. And so, unfortunately, the insurance claim was denied due to lack of warranty compliance. And so how could we have taken care of this prior, and how can we learn from this situation?
Well, it's very important to notice when an insurance company issues a warranty against a cargo, if that warranty is not complied with, then it's probably a good bet that your insurance is negated. In this particular case, the insurance company wanted a warranted armed escort to the final destination because the particular area that they were transiting through inland had a very hot spot for hijacking. Although the insurance company issued the warranty and that was to be complied with, neither the forwarder nor the shipper adhered to that warranty. So when something did happen, there was no coverage available because they failed to adhere to the insurance warranties.
That can be very scary.
Yes, it can.
So our next situation that we're going to falls under a warehouse-to-warehouse coverage. And so in this situation, we have an exporter, and they have several containers, and unfortunately, all of the goods were destroyed in a fire. So there was total loss. Now, what can we do because this loss didn't occur during transit? It was in the warehouse. So how can we recoup anything? How can we protect ourselves?
Oh, that's a very good question because insurance coverage normally only covers goods while they're in transit, not necessarily while they're in a loading point. So if you want warehouse-to-warehouse coverage, also known as consolidation-deconsolidation clause, this should be stated in your intent and also should be stated on your insurance certificate so that you have the ability to collect should there be a loss while your cargo is waiting to be loaded on a vessel or whether it's waiting at destination. If you have a Incoterm where the buyer is, the Incoterm terminates the shipment at destination, let's say you have CID, I don't know, Amsterdam, and but the company that you're selling to in the Netherlands wants to have warehouse coverage extended inland from the point of unloading to their warehouse. Therefore, this needs to be stated on the insurance certificate specifically because warehouse-to-warehouse coverage would not apply to CIP per se because the insurance is going to follow the Incoterm termination of shipper liability. But if you add the consolidation, deconsolidation, or warehouse-to-warehouse coverage on the clause, you'll be able to extend your coverage to the warehousing, and it's at least 30 days. Our policy allows 60, and possibly others do as well.
Well, thank you, Sherry. So now our next situation is one of those misleading things. You think everything's going well, and then surprise. So we have where a container was shipped with a high value of goods, and it arrives at the consignee's warehouse with the seal intact. However, when they open that container, they discover a third of the product is missing with a loss calculated of $150,000. So who can be protected, and how can we be protected for this situation?
Well, this would be a common occurrence possibly with goods that are highly pilferable. And that may extend to even shoes. I mean, you know, some people like shoes a lot. So, but if you've got a commodity that is easily pilfered or is susceptible to pilferage, you want to be sure that you have that you're protected from any shortages that arrive at destination from the container. So you need to have a clause in your insurance certificate that says shortages from containers. This clause would protect you should there be a shortage or pilferage en route. Also notice that the seal is intact, so it appears to be something that was not loaded. So the shipper or the seller has to also prove through either a loading tally or inland freight bill or some sort of similar document that they did load the goods into the container. And as long as they can do that, then this clause would add that protection of pilferage in the container itself. Because criminals can be pretty savvy if they want to be.
Well, thank you, Sherry. And so now our next situation is dealing with FDA and extended warranties. And in this situation, we have heavy equipment exporter who ships a high value of refurbished rock crushing machine. And so during this loading, the stevedores loading equipment failed, so the machine was dropped, resulting in a total loss. So who can be protected, how can they be protected, and how can we take care of this or prevent this the next time going forward with our coverage?
Well, FPA coverage is a very limited coverage. It's usually reserved for commodities that are refurbished, used, or have a low value of some sort that would not be eligible for full all-risk coverage. The FPA does not include loading and unloading, and so the conditions of loading in this particular example were not covered. Now, the seller could have added several clauses to the FPA extending the coverage on the FPA certificate itself, and that would be all risk term that can be added. It could be for jettison overboard. There are, I believe, that's the main two clauses, loading and unloading, jettison overboard, all risk, that can be added to the FPA coverage that would cover something that was damaged while it was being loaded. Because just because it's refurbished doesn't mean it's not a high value. So a refurbished machine could being lost under exclusively FPA could be a substantial loss. Now the FPA, keep in mind too, in order to make a claim against FPA, that you have to prove negligence or liability of the carrier. So it's very prudent to add the extended warranties to any FPA coverage that may apply.
Thank you. Now, in our next situation, we're going to talk a little bit about domestic carrier liability coverage. And so we have a situation where a freight forwarder is instructed by their shipper to secure insurance on a $300,000, so we have a situation where the freight forwarder is instructed by the shipper to secure insurance on a $300,000 load of high-tech equipment from Miami or from Wisconsin to Miami. And so the freight forwarder believes that they've done their due diligence because they've obtained a proof of insurance from a reliable trucker with a limit of up to $500,000. However, then en route, the trucker encounters a severe storm, it results in a serious accident, and then ultimately the claim was denied. So how could we have avoided that?
Well, it's very important to realize that carrier liability coverage, whether it's domestic or international actually, is very limited. That carrier liability is designed to protect the trucker or the carrier, not the shipper, for the goods inside. So you're going to have limitations on the carrier liability. For domestic, it's usually 50 cents a pound. For international, $9.07 a pound. If you do the numbers in your head, you'll see that that's not very much coverage at all. In addition to that, under carrier liability, you again have to prove that the carrier was negligent, or that they had some sort of liability that was incurred due to their lack of fulfilling their obligation in full to carry this load. This case is an act of God, so there is no way that you're going to be able to probably claim against the carrier in this kind of situation. Some carriers will allow you more coverage per pound, but they're going to make that up in the freight rates. So you're going to pay for it one way or the other, and it's not going to be very good coverage. This should never be substituted for all-risk insurance, especially when you have the warehouse-to-warehouse or consolidation, deconsolidation clause that would be available to you. So in this particular case, the forwarder mistakenly thought that the carrier liability coverage, just because it was covered up to $500,000 limit, would protect this particular shipment, and they would be able to save some money, and the shipper might be able to save some money. But it proved to be a complete exercise in futility and a total loss. So.
And that would be a very sad situation, especially with the high tech being usually lightweight, right? And if it's 50 cents a pound, it's quite a loss.
That is.
So we're going to move on to our next situation. So this is a third-party negligence. And we have a situation where the logistics provider specializes in perishable food, and they're shipping a large shipment of fresh meat, and they've been given the instructions to arrange for a reefer container to be set at a fresh meat temperature. However, the forwarder mistakenly tells the steamship line to maintain the shipment of meat at a temperature below freezing. So when the goods arrive, the meat is completely frozen and is rejected by the buyer. What are we going to do about this, and how could we have covered ourselves about this?
Well, third-party negligence is probably a more common occurrence than you would think. I mean, we are human and we do make mistakes. So when you have issued, just because you've issued the instructions to your forwarder or the carrier to maintain temperatures or to not store in the sunlight or whatever your particular condition for your shipment might be or your cargo, this doesn't mean that somebody's not going to make a mistake. And so this is very important to add to your insurance certificate. It's a clause called negligence, and it's recommended for all exporters that do ship perishable goods particularly, or goods that have limited conditions on how they can be handled. It's very easy. This is probably not going to cost you any extra, and you've covered yourself if somebody along the line has made a mistake.
Well, thank you. Now, our next situation is something that, we sometimes think is old-timey or just in the movies, and we're talking about piracy. And so here we have a situation where pirates have hijacked a ship in the Gulf of Aden, and negotiations, as you'll let us know, can take weeks or months. And this specifically is in reference to, the recent, the movie with the Maersk Alabama, and where, Tom Hanks was Captain Phillips. So what can we do, because piracy is still a real concern?
Yes, piracy is still a real concern today, and you can see from some of the statistics that are going to come up here on the screen in a moment that we still have very many incidences. We still have very many hijackings, hostages, and vessels held in the Gulf of Aden, which has been primarily the hot spot for piracy. This area, though, has been so inundated with piracy that many of the surrounding countries have engaged their police to handle attempted hijackings, so that obviously to protect their interests and other countries around them. But this particular maneuver by other countries has also resulted in a decline in the Gulf of Aden piracy. However, it's still a big problem, as you can see from the statistics. If you look at the next picture, some of you may recognize Tom Hanks there and the Captain Phillips of the Maersk Alabama. There are other hot spots, though, that you should be aware of, because piracy is beginning to spread, or has been beginning to spread, to other parts of the world. And if you can look at this red line here, you'll see that these are the areas that are very susceptible to piracy in this particular route. Unfortunately, I could not get Brazil in this particular scenario because it's a long way away from here. But Brazil is another area to keep in mind, especially off the coast of Brazil prior to unloading in those areas, in those ports, rather, that it's also a high-risk hotspot. But piracy is definitely something that you have very little control over. This is a picture of the Somali pirates, and they're pretty ruthless when it comes to capturing ships. But what you can do, and your insurance company will cover you to these areas unless they specifically prohibit you from shipping there or, excuse me, raise your premium to the point where it's not feasible. But you can what you can do is try to avoid these hot spots as much as possible and within reason. The destination you're shipping to may have reasonable alternatives for logistics moves rather than the ones that are most common that have been subjected to piracy. And the other thing to keep in mind about piracy is that there is no loss or damage incurred to the goods per se. So it's not necessarily related to the value of the goods since there is no loss or damage to the goods, but it can affect time deliveries, market values, possibly a temporary loss of cash flow and product supply, that sort of thing. So when it's possible, you should seek alternate routes and try to avoid these areas if you can.
Which yes, sometimes is easier said than done, depending on where you're shipping.
It is. I mean, sometimes logistics it is what it is, as they say. But it's at least be aware of the problem and what can happen. It gives you a little bit of a heads up.
So situations that aren't just in the movies.
That's right.
Our next situation deals with destination concerns and civil unrest. So it's not necessarily, there could be a declaration of war, but it might not necessarily be a full-on declaration of war. There's just threats of war, and and we can flip channels on the news and see real-life events and situations like this. So how do we protect ourselves when we are shipping into those countries that have civil unrest?
Well, generally when you have a country that is undergoing civil unrest of any sort, prior to an actual declaration of war, your insurance provider will still give you coverage into that area, but you may have to pay a premium or a surcharge for war risk that would not normally apply under normal situation. This coverage usually also terminates at the point of unloading the vessel. In this case, when you've got these kind of countries with a higher war risk and with civil unrest going on and the threat of war, you cannot have a warehouse-to-warehouse coverage or a deconsolidation clause because the insurance companies just will not be liable once the vessel unloads. So you have to be sure. They have to be aware of these situations and these areas, just so that you don't promise something to your buyer that you cannot provide.
Thank you. Well, the next situation is one of my favorites because it amuses me, and it's dealing with vessel age, and you see certificates and requirements for vessels being a certain age. And so here we have that the vessel is over 20 years of age, and this poor ship has seen much better days, and it sank en route, resulting in a $250,000 loss. So we hope that our vessels are seaworthy when we're using them to convey our freight, but how can we protect ourselves when there is a vessel that's really past her prime?
Well, all insurance cargo policies will have what they call a vessel classification clause. And this is the number of years that they will allow the vessel age to be insured for. So most underwriters insure from 15 to 35 years of age, but that will vary among insurance companies. So if you've got a vessel that's over the given limit of your insurance company, 20 years is very common, 15 years is very common. I don't see too many that go to 35 years. You need to be aware that, or be sure that your forwarder is aware because of the area that you're going to or the letter of credit or anything that may jeopardize your cargo, that the vessel cannot exceed a certain age. And so you need to exercise due diligence really in that area and kind of check behind the forwarder, make sure that your booking is for a vessel that is within the vessel's age limits that's allowed by the carrier, by the insurance provider.
Okay, thank you. And then our next situation is one of those cases where you believe that the ball is in someone else's court and you're trusting that they're doing their part. So we have a situation where a Miami exporter is selling a $400,000 container on FOB terms under open account. The buyer's supposed to secure the insurance on the shipment, but they didn't. Maybe they forgot, they got busy, or who knows why. And then ultimately the container was hijacked en route to Paraguay. So what can we do on our side as the exporter? Is there, how can our loss be covered or the goods protected?
Well, everybody wants to save money, and this buyer apparently felt that he was not at very high risk of losing anything. And since it was his problem to secure insurance, thought he would just skip it this time. But sellers there's several things that sellers can do to be sure that the buyer is securing insurance. You can request a copy of their insurance policy or certificate and the terms and conditions that are applying to this particular order. More importantly and more to the point is contingency insurance that sellers can get for very high value commodities or very risky areas. Contingency insurance mirrors all risk insurance that the buyer is supposed to secure, but it is at a much cheaper rate. It's usually about 1/3 of the premium cost would normally be, and it gives you full coverage should the buyer fail to secure insurance or should something happen that the buyer does not secure adequate insurance. Let's say he or she insures it for less than the value, because normally we insure for 110%. Let's say that they only get 50% insurance, and if something were to happen and they did get at least 50%, the payout would be 50% of the 50%. So it starts getting pretty low coverage once you start dwindling that down below 110%. It's also important to note that the contingency insurance is a secret. You cannot tell the forwarder or the buyer that you are securing contingency insurance because it would encourage a buyer not to secure insurance, even though it's their obligation to do so. So, and this would apply under FCA terms as well, or Ex-Works, which is not really supposed to be used for international, but Ex-Works and FCA would also fall under this particular scenario. So if you were to reveal that you had contingency insurance to your buyer, your coverage would become null and void because of the temptation for the buyer to not insure the cargo. Now, if something does happen to the cargo and the buyer fails to secure insurance, you're going to be covered 100% by your insurance company under contingency. If the buyer does secure insurance and you have contingency insurance and something happens to the goods, either full damage or partial loss, the contingency insurance company and the full coverage insurance company would dig it out and decide who pays what. So basically it just gives you an added protection that you would not normally have to allow for buyer inconsistencies in securing insurance, anything that's beyond your control. The other thing to remember is that when the buyer is supposed to secure insurance, it's all well and good to say it in the Incoterms, but it doesn't mean that they necessarily do it. And then when the goods become damaged or lost, particularly a full loss versus a partial loss, the buyer may just walk away and kind of leaves you holding the bag. So this is something to take into consideration when you are selling under FOB, FCA, ExWorks, and you feel that you're going into an area that may cause undue risk that would not normally be the case.
Thank you, Sherry. So similar to this last one where, an oops or somebody forgets or just doesn't want to, it can be self-insuring. So here we have our situation is an importer in Jamaica receives multiple container loads per week from the USA and elects not to insure because he's never had a problem with shipment, never had damage loss. However, on just a typical voyage, the ship encounters heavy seas and mechanical problems, and it causes the vessel to jettison cargo, and they declare a general average. So the LC is going, this is under an LC payment, and the LC is going to be on hold, and payment's going to be delayed until the general average is resolved, and that could take years. So here someone chose to self-insure. How could we as the exporter, possibly protect ourselves because the LC is not just on hold and our payment is delayed?
Well, yes, and this would be a very bad problem. Had the importer simply just purchased FPA coverage for the shipment, and especially FPA coverage with extended warranties that might have might have covered the loss, at least, he purchased the minimal. But again, the contingency insurance comes into play here as well. There's just certain things that when you're depending on someone else to secure your cargo, there's all kind of things that could go wrong, and we all know what kind of nightmare it would be to have payment delayed for several years. Now, when a vessel declares general average, this is very, very low coverage because what happens is they take the value of all the cargo on board the vessel and they average it, and then they take only a percentage of that, and that's the reimbursement. Usually it's around 10-20%. So if you happen to be one of the shippers that has high-valued cargo, you're going to be pretty disappointed if something like this were to happen to you. Not to mention maybe a little bit broke.
This is true. Thank you. And so that pretty much concludes our situations and solutions portion. This slide here is just a reminder that bad things happen, and here we have something where there's probably a mishap, and then there created a domino effect with the containers, and who knows how the value of the damage that is in those containers. And then this one, makes you a little seasick, and so it just lets us remind ourselves that we need to make sure that all cargo is insured. So lastly, we asked the question, so who needs cargo insurance? And the answer is you do. And the good news is that you can, contact Sherry and myself, and, if you have another provider, that we've got you covered. And if you have any questions about adequate cargo insurance coverage, please feel free to contact any of us at Trade Technologies, and Sherry is our Director of Consultation and Cargo Insurance as well. So please feel free to just, follow up with any questions. And so at this time, Linda, I'm going to turn it back over to you for any Q&A that we have.
Okay, great. Thank you, Melissa, and thank you, Sherry. Great presentation. Yes, we'll now be taking voice questions. If you have a voice question, please press *1 on your telephone, and I'll turn it over to the operator.
Thank you. At this time, if you would like to ask a question from the phone lines, please press star 1 on your touch-tone phone. You will be prompted to record your name. Please ensure that your phone is unmuted and record your name clearly when prompted so I may introduce you for a question. One moment, please, for questions from the phone line. We have a question from Frank Reynolds. Your line is open.
Hi. On the general average example and the letter of credit, if the shipment or if the vessel already left port and the ocean bill of lading was issued, would that not trigger off payment on the letter of credit so that the general average situation would not be a concern to the exporter?
Well, not necessarily. It depends on the Incoterms, number one. If you're selling under the F terms or the E terms, the insurance coverage is responsibility of the buyer, and the letter of credit may require an ocean bill of lading or a forwarder's cargo receipt. If it requires an ocean bill of lading, the chances that ocean bill of lading is issued, especially if it's a short transit time, may not be the case. In other words, once the steamship line actually sails and releases the bills of lading, it could be already in a bad situation before those bills of lading are issued. But to answer your question directly, it could, yes, be settled if you have all of the documentation that's required by the letter of credit. Yes, you could go ahead and apply the letter of credit to the and get payment, provided everything else is available. The only problem I see, of course, is getting the issuance of the bill of lading if it happens pretty soon after it sails.
Okay, thank you, Sherry. Thank you. And our next question?
I'm showing no further questions from the phone lines at this time.
Okay, let's go to our Q&A session, the written questions. I have a question here from, looks like Amy Ariu. The question is, how do you obtain a contingency insurance?
I'm sorry, would you repeat that?
Sure. How do you obtain contingency insurance?
Well, let me know. All you have to do is contact me and tell me that you want contingency insurance for your particular shipment, and we'll get you a certificate issued for contingency.
Okay.
I don't know, specifically who all provides that. Forwarders generally don't, but definitely we do.
Okay, sounds good. Thank you. Also, I'd just like to remind the audience that now is your opportunity to ask your questions, because we do have our experts here, and they are here really for you to go over any particular situation, like they had mentioned in this PowerPoint, any situation that your company is going through or any foreseen situations. Please take advantage of this time, because they are here in this webinar, and this is live, so they can immediately answer your question now. And I will just turn it over to operator one last time for voice questions, and then from there we will conclude the webinar. So let's give it to the operator one more time for any voice questions.
Thank you. And again, as a reminder, please press star 1 on your touch-tone phone to ask a question. We do have a few that just came in. We have a question from Holly Walker. Your line is open.
Yes, could you please provide the acronym for FPA coverage and expand on that a little bit?
FPA coverage is free of particular average. And what that means is that the coverage is very limited, and it's based on general average coverage that I explained when a ship declares general average. Also, it's very limited to the actual voyage and transit itself. It requires you to prove, in order to collect, it requires you to prove that the carrier was negligent in some way, perhaps they were drinking or they were not paying attention and ran into another vessel or whatever. You have to prove that negligence, which sometimes can be very difficult. Now, if you add extended clauses that are available to FPA, like I explained, such as jettisoning cargo overboard, that would be covered, or loading and unloading, that would be covered if the goods were damaged while they were being loaded or unloaded, which would not generally be covered by FPA. But you can add those clauses to your FPA coverage without any additional cost. Does that answer your question?
Thank you.
Our next question comes from Ms. Rodemaker. Your line is open.
Hi. We insure by sending our commercial invoice to our insurance agent. That usually is after it's been loaded and often out. So when you were talking about areas of like hotspots for piracy, war risk, civil unrest, we wouldn't know that. We wouldn't get anything until after we've already, shipped the vessel out. Other than, what we hear on the news, but we don't know if the insurance company has designated an area where they will now discontinue warehouse-to-warehouse coverage.
I'm sorry, could you please repeat your question a little louder so maybe others can hear?
Insuring our cargo is...
I'm sorry, can you speak a little bit louder?
Okay. Our normal way of insuring our cargo, is that better?
Thank you.
Okay, is by sending a commercial invoice to our insurance agent. And quite often we don't do that until after the cargo is already on the vessel and en route. What I'm concerned about is when we talk about hotspots of areas of civil unrest, piracy, war risk, we know certain areas from the news, but there may be areas that we are not aware of. And you made the comment that war risk coverages terminates at those points of unloading the vessel, and warehouse-to-warehouse coverage will not be provided. I'm just wondering how we can, do insurance agents notify you, like if they know, is it the insurance agent's responsibility to notify you that, hey, you've been shipping to Russia all along and now it's an area of civil unrest and we won't cover warehouse-to-warehouse, or where does that responsibility lie?
Well, that's a very good question, and I'm not sure that there is a designated responsibility. Certainly, we would, and our carriers would, insurance carrier underwriter would advise us or keep us abreast of anything that's coming up that may cause termination at the port of unloading and be a substantial war risk surcharge. I would think that your insurance provider should take the initiative to do that. I don't know that there's anything that says that he has to or she has to. The only way to monitor, I guess, that particular situation is to, if you feel like it's an area that may be have problems, is to contact the representative and ask them what the costs are going to be. Is there going to be a war risk surcharge? And is there going to be termination at the port of unloading? Asking them point blank. That's the only way I know to do it. Otherwise, we would have that information ahead of time. Our underwriters give us updates all the time as to what areas are at risk.
Thank you very much for your question, and thank you, Sherry. Okay, we'll continue with voice questions. Any more voice questions?
We do have one more question. Felipe Pirano, your line is open.
Yes, thank you. Let me ask you, when you always transfer the risk of the transaction between the buyer and the seller, depending on what Incoterms you have, right?
Right.
Okay. We are forwarders. At any point, if we receive the cargo here in the warehouse, and as you said, we have the warehouse, if the buyer or seller has a clause of the warehouse-to-warehouse coverage, they will be covered if any incidents happen on the route or during transit. And unless we as a warehouse, don't commit any negligence on our part, are we legally liable at any time?
Well, that's a good question, and could be a very complicated question and answer. But let me just say that the liability for the insurance coverage does rest with a party, and if you want warehouse-to-warehouse coverage, you can't assume that your insurance policy behind your insurance certificate is going to allow that on every shipment. So it specifically would have to be stated on the insurance certificate, warehouse-to-warehouse or consolidation, deconsolidation clause applies. As long as those two items are on the certificate and it's not a restricted area for war risk or anything like that, and it sounds like you may be importing, so it probably wouldn't be, then you should be covered. If those clauses are missing from that certificate, then you do have a possibility that your warehouse-to-warehouse coverage would not exist.
And at some point, my question then is, I appreciate that clarification, but it's as freight forwarders, right? We're the owners of the warehouse, but not of the goods. We just hold them. Are we liable if, for example, the goods are stolen from the warehouse, or is there a fire? Or will the buyer be the ultimate responsible for insuring the cargo?
Well, it's a good question, and it basically, what it does is it crosses over from cargo insurance to liability insurance. And the simple answer is it could be both parties. If your warehouse as a forwarder were to catch on fire, or if goods were stolen from there, your liability insurance would kick in and reimburse you and your shippers or clients from that loss. But if the insurance is also covered warehouse to warehouse under cargo insurance from the buyer or the seller, then that would also apply. So in this particular case, you may have a situation where two insurance companies are,
we'll find it out
and pay it out. Yes.
Yeah. Okay. All right. Thank you.
Makes sense? Okay. Sure.
We have no further questions from the phone lines.
Okay. Well, we do have more questions through our Q&A session. So let's go to the next one. This is from Courtney Jamstetter. She asks, I strongly believe that our company should purchase additional coverage for our international freight shipments. However, our executive board does not agree and operates based on the probability of an issue being very little. How would you respond to this objection?
Well, that's a good question, and, sounds like a political question internally, but I would say what comes to mind is penny wise, pound foolish. The probability does not come into play with insurance, cargo insurance, because even though there may be statistics of what may or may not happen, it doesn't mean that it will or will not happen. So probability is kind of a foolish might be a little strong. It's kind of not a good way to value whether you need cargo insurance or not. If you consider how much your premium costs you, even contingency insurance or FPA, the very minimal coverages, if you consider the cost of those against the risk, total loss, total damage, partial loss, partial damage, it probably will be no contest. It's better to be covered when that once-in-a-lifetime issue comes up, or your number comes up for being hijacked or having a problem with a vessel sinking or any of those situations. It's better to be prepared with at least the very minimal coverage than to not have any insurance at all, because that's unless you're shipping just really low-valued shipments, the insurance premium is going to be a minor cost and a prudent investment in your goods.
And also, isn't it true, Sherry, this is Linda, once things leave the United States and they're exported, there's no coverage. There's no recourse because now it's entered into a different territory and a different legal system. So even anything that happens from that point on is very difficult to resolve. Is that true?
Yes, that is true. Thank you for bringing that up.
Yeah, here over at Global Markets, we handle a lot of questions like this, letting small and medium-sized businesses know that once they leave the border, there's really no recourse. And if that happens, we can help you out through that by giving you some people and colleagues who can help you with those situations. So just wanted everyone to know that. And I just wanted to make sure to confirm that with you as well.
Yeah, that's true.
Another question I have here is from Christina Sanchez. The question is, I noticed there was no mention of the Institute cargo clauses, but isn't third-party negligence included in standard all-risk coverage, in quotations, ICCA, or does it have to be specifically requested even if the coverage is under, ICCC? And I guess if you could just go over what those acronyms mean, ICCA and ICCC.
Well, that's a good question, and I'm sorry, I kind of got lost in the question. Did she mention third-party negligence? Was that the question?
Yeah, let me repeat it. It says, I noticed there was no mention of the Institute cargo clauses, but isn't third-party negligence included in standard all-risk coverage, in quotes, ICCA, or does it have to be specifically requested even if the coverage is under ICCC?
All right. Well, all-risk insurance does cover the Institute cargo clauses that are very common to cargo. It's actually broken out into A, B, and C terms. But if you get all-risk insurance, then you're going to get the all clauses. I know that some letters of credits require Institute cargo clauses, Institute strikes, riots, theft, non-delivery, that sort of thing. Those all come under an all-risk kind of policy. The third-party negligence does not. So if there were to be a third-party negligence of some sort, then the policy, without that specifically stated on the insurance certificate, would not be covered should an incident occur from a third-party mistake.
Okay, thank you very much. Next question here is from Michael Height. For insurance coverage, all risk from port of loading to port of unloading with no risk after discharge and cargo is damaged at time of arrival to final destination, also known as the consignee location, is it covered? If so, how is it determined where it was damaged? I'll repeat that. For insurance coverage, all risk from port of loading to port of unloading with no risk after discharge and cargo is damaged at time of arrival to the final destination, also known as the consignee location, is it covered, and how is it determined where it was damaged?
Well, that's a very good question and a million-dollar question. Sometimes damage cannot be determined specifically where it happened. But if your coverage terminates at port of unloading and there's no clause on the certificate that states warehouse to warehouse, and I don't know if in this particular situation that you're asking if it's insurance run or if it's just something that you provided, any incidences that happen after you unload the cargo would be your buyer's, the destination party's responsibility, unless your insurance certificate specifically states otherwise. Now, again, where damage is incurred is sometimes a million-dollar question and has to be proven, but just in a black and white world, damage after unloading would be buyer's responsibility.
Thank you very much. And also, I have another question here from Felipe Peruano. Are we going to get a copy of the presentation slide? Yes, everybody will get a copy of the PowerPoint presentation slides. Also, we will have an FTP net replay of today's webinar, so everyone will also get a link and login instructions on how to view this webinar. And with that, then, I am going to conclude today's webinar. Remember, for those of you whose questions we weren't able to get to, or you might have questions later on after this webinar, please just make a note of the contact information that's in front of your screen. So you can contact Sherry or Melissa at any time, and there are their emails, addresses, as well as phone numbers. Also, please check out Global Markets at the Department of Commerce's website. We have a website, www.export.gov, and as I was saying earlier, we have agents, international trade specialists, on a 1-800-USA-TRADE phone number where we can also help you out with exporting questions. And if you are in a situation where there's a lot of issues or disputes, we do have contacts, and we do have ways of assisting you in those areas as well. So please check out www.export.gov for more information on exporting-related topics and terms, as well as webinars. We're going to continue a series with Trade Technologies in the fall, and we're going to develop some more topics. So please keep checking that site for more information on the webinars. So with that, I'd like to thank everybody for joining us. Thank you to Melissa McLemurray and also to Sherry Lane for their expertise and time. Also, thank you to Melissa Freeman of Trade Technologies. She is the marketing specialist who really helped assist and market this webinar. So thank you to all of you. And also, of course, thanks to our participants. We do this for you, so please check your email boxes for more information on upcoming webinars. Thank you, everybody, and goodbye.
Thank you.
Thanks.
That does conclude today's conference. Thank you for participating. You may disconnect at this time.